Welcome back to Alpha Recap. Mark here, relaxed as always, and we're breaking down the market action from after the close on July 29th. Quick reminder, if you have questions, you can reach us at stockalpha.ai. Tom, good to have you.
Thanks for having me. A lot to unpack from the session. We had a pretty clear split between big tech-led strength and weakness in small caps and banks.
So, headline numbers first. The S&P 500 finished the day up about 0.4%. The NASDAQ 100 jumped just under 1%. Meanwhile, the Russell 2000, the small cap benchmark, was down about 0.6%. Big picture, large cap growth led, small caps lagged.
Right. That gap framed a lot of the trading. Money piled into mega cap tech and AI beneficiaries, while smaller and bank-exposed names were under pressure.
So, what really stands out here is that it wasn't a broad market rally. It felt concentrated.
Exactly. The NASDAQ 100 outpacing the S&P 500, while the Russell 2000 lagged, is the textbook sign of concentrated leadership. A few big names driving the tape.
Walk me through the why. What pushed tech and cyclicals higher, and what pushed banks and small caps lower?
Three main crosscurrents. First, continued appetite for AI stories and consumer tech momentum. We had examples like Laureate Education signing a 3-year AI deal, headlines that feed the AI narrative. Second, materials and industrials got a lift from deal activity and defense contract news, plus an upgrade on Rio Tinto. Third, financials and small caps were pressured by questions about credit growth and regulatory chatter. And then there was stock-specific volatility, most notably Tesla hitting a 52-week low, which added headline drag.
Wait, Tesla hit a 52-week low? Really?
Yeah, it did. That was one of the day's biggest single stock stories. Even though that move was company-specific, Tesla's size and role in growth narratives amplified volatility in parts of the market. And that matters because when a marquee growth name stumbles, it tends to yank sentiment for other growth and mobility plays.
Let's break sectors down. Tech first. You said durable leadership. What did we actually see?
Tech and communication services led, thanks to concentrated buying in mega cap names and ongoing media coverage around AI deals and product updates. In plain terms, investors liked the earnings visibility and the AI angle, so those large names attracted more capital.
And materials and mining? That felt like a surprise strength to some.
Materials did well. Deal announcements and commentary about rare earths, along with Goldman Sachs upgrading Rio Tinto, pushed miners up. Analysts noted stronger pricing in certain industrial metals, which drew rotation into cyclicals.
Right. And the other thing is, industrials got a bump from defense wins.
Yes, defense contract momentum and manufacturing optimism helped aerospace and defense supply chain names. So industrials benefited alongside materials.
Utilities and renewables. Mixed, but constructive, right?
Mixed. Utilities saw selective interest tied to grid modernization, and some solar-related names picked up bids. But the renewable complex remained uneven because of supply and demand dynamics in parts of that sector.
Energy was kind of neutral?
Yes, a few nuclear and midstream stories got attention, but solar showed softness in places, so overall, energy was mixed.
And financials were weak. Tell me what was driving that pressure?
Bank stocks were pressured by renewed questions around credit growth, modest deposit outflows, and regulatory commentary. Smaller regional banks and small cap financials, which weigh more in the Russell 2000, were the most affected. So small cap underperformance and bank weakness were closely linked.
A couple quick calls out from the tape. Nokia dropped, Goss popped, Rio Tinto got upgraded, Laureate with that AI deal, and Cobblestone announced a legal tech demo. Anything else stand out?
Nokia fell roughly 3.5%. Goss rose just under 3%. Rio Tinto responded to the Goldman Sachs upgrade. Laureate signing that 3-year AI deal was emblematic of AI commercialization seeping into non-tech sectors. And Cobblestone's legal tech demo is one of those niche software monetization stories that traders liked.
Honestly, I was a bit surprised by the spread between megacaps and small caps. The technical picture, what did the internals say?
From a market structure perspective, the internals showed leadership consolidation. The NASDAQ 100 beat the S&P 500 while breadth deteriorated. Volume was mixed. This pattern, a handful of megacaps carrying performance, often comes before broader participation, but only if earnings, macro data, or liquidity give investors confidence to rotate into mid and small caps.
Let's talk macro and Fed implications. With no big data prints, how are rates and policy expectations shaping positioning?
Markets continue to price a data-dependent Fed. Analysts noted inflation is slowly cooling, but services inflation and wage trends remain important. So the consensus was for a relatively flat near-term policy path, with easing only if disinflation becomes clearer. At the same time, bank sector stress raises the risk that tighter credit could drag on smaller firms and GDP growth.
So credit tightness could be an indirect headwind to earnings for smaller companies?
Exactly. If lending conditions remain tight, small companies that depend on bank credit could see slower growth, which would weigh on small cap performance.
Short reactions. Yeah, that tracks. Okay, looking ahead, what should listeners watch when markets reopen?
Keep an eye on earnings and corporate headlines. Those will drive near-term stock moves. Follow any Fed comments or surprise macro prints. Employment or inflation surprises could reprice rate expectations quickly. Watch banking earnings and loan loss commentary for signs of stress or relief. And monitor marquee names like Tesla. Continued volatility in those names could influence risk appetite.
Give me 3 simple scenarios: bullish, bearish, and base, in one line each.
Bullish. Megacap tech keeps beating estimates and macro data improves, prompting rotation into mid and small caps. Bearish. Bank headlines or weak macro prints trigger risk off, hitting small caps and cyclicals. Base. Leadership stays concentrated, with the Nasdaq 100 and megacaps holding gains, while breadth slowly grinds mixed.
Quick micro takeaway for traders who like to watch breadth.
Breadth matters. Persistent leadership by a few names creates vulnerability if sentiment flips. Watch advanced decline trends and volume confirmation before assuming a broad rally.
Final takeaways. Hit me with the top 3.
1. July 29th reinforced a split market. Strong tech and large cap leadership, while small caps and bank names lagged. 2. AI headlines and deal flow supported concentrated gains in materials and tech, but bank and credit concerns kept pressure on smaller names. 3. Watch earnings, Fed signals, and bank-specific updates for the next moves in breadth and risk appetite.
Great. If listeners want to dig deeper on any of this, how do they reach you or the...
Head over to stockalpha.ai and you can ask us questions directly there. We'll answer live through the Q&A feature.
Perfect. If you have questions about anything we covered today, head to stockalpha.ai, where you can ask us directly, and we'll answer live. For more market analysis and insights, visit stockalpha.ai. Thanks for listening. We'll see you next time on Alpha Recap.